Hello, everybody. I'm Michael Smith, and this is The Lowdown. This week, we have our very special guest, Kevin Lennox, back in studio with us. Kevin, welcome back.
Yeah, happy to be here.
This week, I've been getting a lot of questions about the inverted yield curve. Yeah. It's just about everywhere you look. Go to the internet, go to the blogs, you go to newsletters. Everybody's coming out in droves talking about the inverted yield curve. I thought let's just start off simple. What does that mean?
Yeah, it is pervasive. My wife even asked about it.
Oh, really?
What the heck is that, and is that bad for us?
Yes.
So the technical definition is the 10-year Treasury yield minus the 2-year Treasury yield.
Okay.
And so this week, the 2-year Treasury, which is very unusual, had a slightly higher yield than the 10-year Treasury yield. But no worries now. We're back to about a positive 0.20%, so the bull market can continue, and no worries.
So basically, that's over for the moment.
Yeah, forget about it.
Well,
so I'm kidding there.
Yes.
So brief inversions of the yield curve really are not a big deal. But a more extended period of yield curve inversion, like we had in 2006, is much more worrisome. Now, it gets so much attention because it is one of the better leading indicators that's out there, and it gives a good lead time. And kind of what it goes, the fundamental reasons for the validity of this indicator ties to the profitability of the banking sector.
Okay.
So banks borrow short and lend long. So when that curve is compressed, that impacts bank profitability. And if you're going to make less on loans, you might be less inclined to make new loans. And oh, by the way, if you're going into a recession, then you're likely to have loan losses. So outside of exogenous events like, well, spike in oil prices,
yes,
war, it's usually the credit cycle that leads the decline in both the broader economic cycle as well as the stock market. So that's the underpinning for why it's so important to watch, but it's really a yellow flag.
Okay.
Right? You go to the beach and there's a yellow flag up above it.
Caution.
Caution, exactly. It doesn't mean the end of the world, but the perma bears are certainly having their day in the sun on CNBC saying, this is it, this is the recession coming. And I think it's way too early to call that or even position a portfolio for that. Now, I will say we are going to have, likely going forward, a structurally flatter curve. And what I mean by that primarily is that the 10-year Treasury yield is likely to stay range bound at a lower level than it has in the past. And the principles behind that are that we do have an aging population.
Okay.
We do have automation and technology, which take some people out of the labor force,
yeah,
and that lowers the level of potential GDP growth. So short-term cyclicality, I think, will more frequently in the future cause yield curve inversions. Some will be meaningful, some will not. But we're also seeing pressure on the 10-year yield right now from events like war,
Correct.
a flight to safety, but also as part of that flight to safety, the US dollar has been so strong, it's attracting foreign capital.
Okay.
Our yields are relatively attractive, and you make money on the currency.
Well, you hear things, and I think why a lot of people are getting so unwound about the inversion is you hear things like it's an 80% probability of a recession. Now, how do we at Avidian Wealth, how do we utilize a signal like this? What do we do once we see something like this in terms of like the canary in the coal mine? What do we do with this?
Right. So I'll call it stagflationary pressures have been building for a number of months, well before the war started. And what that means is slower growth, higher costs, and for example, on the fixed income side, bonds, we've been focusing on shorter duration bonds, okay, and higher quality bonds to reduce the interest rate risk as well as the credit risk. And then we also have some, depending on the client, different types of inflation hedges as well.
So our portfolios are already built out. If this is a precursor to a recession, we're already designing our portfolios ahead of time to be withstanding of whatever there is to come.
Right, and to jump to the equity side then, we have a tilt toward higher quality, large cap companies that are better positioned to be able to pass along price increases. than other companies. Companies, Morningstar calls it companies with a wide moat,
Yes.
for example, and we expect larger companies to do better than smaller companies. Oftentimes in a recession or when things slow down, capital becomes more scarce, and small companies are less adept to dealing with a period of rising costs. So we've seen notable outperformance between large cap and small cap, and that probably continues through this phase of the cycle.
Well, Kevin, we've been talking about inflation, but I think one thing I want to kind of turn to the Fed, right? The Federal Reserve, they're supposed to try to contain this and get this into, some sort of containment. How difficult would you say is it for the Federal Reserve to get us to the ideal inflation level?
Well, the Fed has a lot of confidence, but let's have some fun with this and play a clip from Ben Bernake, who was head of the Federal Reserve in 2010.
Okay.
Can you act quickly enough to prevent inflation from getting out of control?
We could raise interest rates in 15 minutes if we have to.
You have what degree of confidence in your ability to control this?
100%.
So that was a rather unfortunate comment, but honestly, as you know, you've been in this business a while, we always eat humble pie in this business if we actually try to say something. And I've said for a long time now, there are two types of people that forecast interest rates and inflation. Those who don't know, and those who don't know they don't know.
So bottom line is that if the Fed had a shotgun, they wouldn't have hit the side of the barn basically with that.
They honestly just follow the bond market.
Yeah.
Look at what's going on right now. We've had one 25 basis point hike in rates, and the 2-year Treasury, which it generally sort of follows or mimics, is at 2.5%, call it.
So this week we had the Fed minutes come out, right? So if you look at the Fed minutes, I don't think there's anything in there that was shocking to the market.
No.
But what they propose right now is basically 7 rate increases, right? And if they talk about 90 trillion in terms of what they called quantitative tightening, or you're going to hear the term QT, right? And so that's balance sheet reduction to about 90 billion per month. So if you kind of do the math on that, that's about equivalent to a 350 basis point increase for this year if it goes as planned. And I'll just remind people back in the 2000, and if you can see here, in 2017 and 18 where they raised rates, quickly, remember Bernake or Powell pivoted, and boom, it came back down. And I think that, we're not even going to get off first base before the economy and the stock market feel the effects of this. So I don't even think we're going to get even close to this.
That pickoff pitch is going to come fast.
Yes, it is. Yes, it is. And then, of course, Lael Brainerd, she came out and she was a Fed governor, and she talked about now this new term called inflation inequality, right? So that may indicate that they come out pretty quick with maybe their proposed rate increases. But like we said, and like we've talked about in the past episodes, is the economy and the stock market get hit quick. We saw back what they did the last time this happened. The S&P nearly sold off 20%. So are they going to continue with it when the markets react, or the economy starts to slow down? I don't think so.
They're fighting for credibility right now.
Yes.
If you see the level of inflation, CPI printed last month at 7.9.
Yeah.
Fed funds rate, the upper range is 0.50. They are horribly behind the curve. We have negative interest rates. They have not even begun to tighten monetary policy to any degree. So what was a little surprising, I guess, from yesterday was who made the comments, being Lael Brainerd, a dove.
Correct.
And a faster pace. It was maybe 95 billion per month in runoff of the treasuries that the Fed has been holding. So it's not selling the bonds, although they may sell some mortgage-backed securities. But I said last time, I still stand by this, that the Fed really is trapped. They have to go for credibility here. So now they're talking about multiple 50 basis point hikes successively. And the futures market is pricing in rate hikes that go to what they think is the neutral rate, somewhere between 3.5% between now and the middle of 2023. But when you look at 2024, rate cuts are being priced in. The Fed is in essence trapped here. They will tighten as aggressively as the market will let them. And they always talk about financial conditions. And when they talk about the Fed put, and if the stock market goes down a certain amount, 15, 20%, then the Fed will come in with accommodative policy. Not really. It's the financial conditions in the credit markets, the transmission mechanism of credit flowing through the system, the ease of which that takes place at a fair price. And their decision point is going to be what happens when we get there. They're going to tighten until we get there.
Yeah.
Which is a headwind for the overall markets, risk assets.
So for the average person listening, this should be, the time to act is now. I mean, if you go back and look at other recessions, by the time the NBER called the recession, the move has already happened. So this is why if you feel like you're taking too much risk, this is the time to analyze that, talk with whoever it is that's helping you manage that, and take the action now, not wait till later.
You know, Mike, since really the Great Recession, the Fed has led a lot of people to believe they can confuse brains in a bull market. And just a simple 60-40 did just fine. We had low interest rates, low growth, low inflation. That's nirvana. It doesn't take brilliance to manage a portfolio in that environment. Just don't do something stupid. Now with rising inflation, wage costs, higher commodity prices, it's a different game. And I think portfolio management and construction is more important now than it has been probably through most of my career, which is a while. I've been through a few cycles, and there are times it matters a lot more than others. And people really need to understand what they own and why they own it, because a mistake can be extremely costly.
So making sure you stay in the boundaries of your plan and don't get too cute. I mean, there's some people that say, look, I'm going to ride this out, meaning I'm going to go to cash. That is even probably a worse idea than just sticking to the course. Many people trying to time this, as we saw back in the last time this happened, that pivot in 19, the market reacted and responded very quickly. Most people would have never gotten back in. So having your plan guide you is probably the best thing to have happen here.
And you know this. I mean, we were in business a long time. We manage money with a steady hand. So I mean, it's the trick in this business almost is who can stay long the longest. In other words, who can stay in the market the longest. And that you have periods like this, a slowdown in growth. Most are just that. And then we resume a faster pace of growth, a false alarm, if you will, for recession. But then there are those where it is becoming something much worse.
Yeah.
And that's where, I spend a lot of my time in trying to decipher, is this broad-based and really weakening? And I look at all the economic indicators everybody else looks at as well. I also follow institutional footprints and what their behavior is in different asset classes. Are they risk-seeking or are they battening down the hatches? So it's a comprehensive type of approach. It's very hard. You never know for sure. You don't. But that point where the growth slowdown, where some people, like you say, will be inclined to go to cash, and then guess what? Something happens, growth resumes, the market all of a sudden is 5-10% higher. Well, then what do you do?
Yeah. Well,
and you missed out.
Absolutely. And I would just say expectations, we're going to see, very quick volatility here. We're going to get through this, but ultimately, stay in the confines of your plan and what your portfolio construction says to do. Don't go outside of that and don't take too much risk.
So Mike, last week, the University of Michigan Consumer Sentiment Survey came out. And it's been going down for months, but hit the lowest level since 2011. So you can really see the impact of inflation on consumer behavior. And on this next slide, you can see how consumer cyclical stocks are doing versus consumer staples. So consumer cyclicals be examples like the home builders,
Okay.
auto manufacturing, retail, versus the travel stocks, the leisure stocks, hotels. Those have been doing just fine here. So people bought all their goods last year and a half post-COVID. Now they've turned more to services. And that does imply a weakness in the consumer, that durable goods cyclical goods from consumers have dropping off that fast. That's one of the things that I look at after I look at financial conditions and credit. Is what is the positioning between cyclicals and defensives?
And so this is showing a sign of a slower economy, correct?
The rotation. So investors are positioning for a weaker consumer through slower growth and higher prices. Consumers have just shifted their preferences between goods to services now, and we're seeing dramatic differences in returns as expected So many of the consumer cyclicals are down 20, 30% right now, whereas the staples, the leisures, and services are down, maybe 5-8%, and similar to the S&P 500.
So you get the inverted yield curve. You go to now that's a canary in the coal mine. You go to some of the other things you're looking at that's showing weakness and kind of staying on, is this a precursor to the recession? Well, let's just remind everybody, the consumer is what, 70% of GDP. So that is going to be significant. So if we do see 2 quarters of decline in GDP, ultimately that's led to be what's a recession. So again, these are the things that we look at. One signal isn't the signal, but this leads us to look at other indicators and keep reviewing those to see what it tells us.
Yeah, the good news is that the credit markets really haven't cracked yet.
Okay.
That's like the best news of the things that I look at right now.
So that'd be kind of the next step to really alarm us if we start to see that
If
happen.
credit cracks, I'll be much more concerned.
Okay.
But we have a war in Ukraine. The path of potential outcomes is unclear. There are banking risks in Europe.
Correct.
And China came out with their services purchasing manager index, which was a 42, which is extremely weak.
Yes.
So there are headwinds, but there are also opportunities and pockets where you need to be positioning your portfolio.
And just keeping in mind, below 50 is
Means
recessionary,
contraction.
right? Above
Correct.
50 is expansionary. So 42, that's pretty low in that regard.
So it's one of those times, if you manage money yourself and you haven't had a portfolio review done by a professional, I would strongly urge you to do that now.
So the signal is now on that.
Yeah, and we do this on a complimentary basis. I do it quite frequently, and it's always an eye-popping experience. People either have gaps or duplicity in their portfolio and risks that they were not aware of.
Well, I'll tell you, Kevin, if anyone needs a portfolio review, they can get to our website. They can email you or myself, and they can get that to us, and we're happy to do that for them.
Absolutely.
So, Kevin, last month when you were on, we talked about the energy space, and I want to get your thoughts on that. I think we gave a pretty good advice. For those that were taking maybe more risk than they should, it might be the time to start looking to reduce or maybe taking some profits off the table. How do you currently feel about the energy space and where it is today?
My view, the things that I look at, it looks to me like it's become a crowded trade.
Okay.
In that,
what does that mean?
People that never used to ask about energy before, and people I follow in institutions that were always anti-energy, and they were ESG, and that's the way. And technology is going to replace.
Nobody wanted to touch it a year
exactly,
ago, right?
Yeah. So I went from Debbie Downer for years in the energy sector to all of a sudden the energy bull.
Yeah.
And it's been a great run. Every time on the radio over the last year and a half, I was talking up energy. Now I think it's a much more balanced risk-return profile from here. A lot of hot money has come into the space. Valuations, I wouldn't say are stretched, but anybody worth the salt knows you don't trade energy stocks based on valuations. So if you've had a big run in energy stocks, it's time to take some chips off the table. As I always say, you date energy stocks. You don't marry them.
That's a good. I like that one. That's
very
smart
cyclical.
advice.
These companies are not like Microsoft and Apple that can keep coming out with new products, open new markets, and grow. Oil companies can't do that.
Yeah.
They are the heart of cyclicality in the market, along with basic material stocks, and you just need to trade those differently. So where it's an overweight, I've been trimming it. I like it for part of the portfolio, but what I'm seeing here recently for the first time in like ever is people coming in with 15 to 25, 30% of their portfolio in energy for the first time.
Okay.
They never had it before.
Yeah.
Well, it's going up. We all know that. And there's a shortage of supply. Oil prices, oil stocks trade more based on the rate of change in demand.
Correct.
Than it does supply. So to say, oh yeah, we're going into a recession, but I'm going to buy energy stocks. Wait a minute.
Yeah.
Catch the contrast there?
I got that, yeah. Well, and there's a lot of exogenous things that can change that and quickly. We all know.
And either way, my point is
yeah.
the risk profile is much more challenging now than it was before.
All right. Well, some good advice from last month. Same advice this month is, hey, reduce weight. Don't go too far over your skis. But good advice. Well, Kevin, look, as always, great to have you on the show. Good advice and good commentary. Thank you for coming.
Yeah, thanks for having me. I enjoyed
Absolutely.
it.
Guys, as always, if you have any questions, comments, need to send myself or Kevin an email, get by the website. We're happy to help you. As always, like and subscribe. See you next week.